Yet again, another week off to say goodbye again to Cambridge, as they say in the Chinese poem. Anyway, my original plan was to talk some about the literature that's followed Dybvig, which is actually there's a lot of literature, and I don't know it all. And last week there seemed to be a very strong sentiment that people wanted to hear more about policy things. And so I'm going to talk about policy, and this talk feels even weirder than the last talk, because last time I'm going, why am I giving this extremely low-tech paper for such a highly quantitative audience? Why don't I do some of my work with Chris or with Hong Leo? Well, this is a lot lower tech than last week. So I'm going to talk about big picture things, I'm going to talk about the economics, and I'm going to talk about some implications that I see from the literature that's out there. A fair amount of this comes from a policy-oriented paper I wrote with Doug Diamond and published in '86. And most of that actually I stand by. The discussion of money market mutual funds in there is a little embarrassing at this point, because basically we talked about money market mutual funds in normal times when you think of them as just holding very liquid assets and having very liquid liabilities and being just a pass-through. But of course, as we've seen with a vengeance, in times that are not normal times in the money market funds, assets are not so liquid, and they look just like a bank, and they're subject to runs just like a bank. And I don't know that I'll spend a lot of time on this, but actually it's worth noting that the money market mutual funds were at the center of two big financial crises. This crisis, it was certainly something that the regulators had to deal with, and they put ex post deposit insurance on the claims in order to stop the runs in the money market funds, money market mutual funds. They were also at the center of the savings and loan crisis. In the savings and loan crisis, they had mortgages. Well, the savings and loans had mortgages which were fixed rate mortgages, and they were supposedly protected from interest rate variations because of Regulation Q, which capped the interest rate that they could pay and that commercial banks could pay on deposits. There's actually a little political part in this. The cap on the savings and loans was 0.25% higher than the cap on commercial banks, and that was to encourage homeownership and make it easier for the SNLs to get funds. I remember when I was a youngster and first putting money in there, I was wondering what was wrong with them that they would have to pay extra. And so I think that probably other consumers were confused about this, which is the only reason why anybody put money in the commercial banks at the lower interest rate. But anyway, when the savings and loan crisis hit, it turned out that the Regulation Q, the cap on interest rate paid on deposits, did not protect the savings and loans, because the money market mutual funds came in and arbitraged the difference between the market rates, which had gotten very high. At one point, prime rate was 16 point something percent. And the rate that was paid on deposits, which I think was 5.25% for the SNLs. And so once they didn't have a lot of their deposit base left to go to the money market mutual funds, this is where money market mutual funds were a big part of that crisis. Then they had to pay ordinary market rates, and they were sitting there with these long-term mortgages at 7 and 8%, and they're paying 14, 15% for their money, and then they had some difficulties. But it's interesting that the savings and loans, who were at the center of these two big financial crises, got off scot-free, and there's almost no change in the way that they've been regulated. I I think they have very good lobbyists. This is an example of the role that politics plays in everything. So anyway, let me continue on this and talk about some things. Anyway, mostly I stand by what we say in this paper, and I think a lot of the issues that are coming up now for discussion are actually discussed in this paper, and the people seem not to have thought of the arguments that we're making back a long time ago. That goes wrong. Okay, add it backwards. Hold upside down, you see it. Okay, so here's some policy conclusions from the things that I'll be discussing. First one is that market discipline is unlikely to be effective. This meant almost the same thing back then as it does now. Now, of course, it's one of the three pillars of Basel, and there are a couple things going on. In the context of Basel, the market discipline means two different things. One thing is that the regulators should look at financial instruments to try to get more information about the entities. And so it's kind of, let's take advantage of the wisdom of the market. That's actually a useful idea, but it's not as useful as you'd hope, because by the time information gets out into market prices, it's kind of too late. But it is useful to make use of market prices to inform yourself about things going on in the financial markets and to form an opinion about how to regulate things. The other part, which is what I meant, and Doug and I meant when we worked on our paper a long time ago, and is the other part of Basel, is to try to give incentives for people to monitor the banks and to take action. And I think it's fairly easy to give incentives for people to monitor banks, but it's hard to give people incentives to do any beneficial monitoring of the banks. Let me give you an example. So there was a bank called Continental Illinois in Chicago that failed a few years before we wrote our first papers. It was around 1980. I don't remember the exact year. But when the bank was getting risky, there were a lot of uninsured deposits. And at that time, the domestic uninsured deposits felt confident, and probably with good reason, that they would be made whole by the regulators and that they would get bailed out. But the international depositors, who had more than the deposit insurance limit, were concerned about whether they would get bailed out, and they monitored the bank very carefully. And within the week before the bank was shut down by the regulators, a lot of them left. Okay, so they were monitoring, but it actually caused damage. It didn't help anybody. It didn't provide any good incentives for the bank. When they took all these deposits out, it made the regulators act precipitously, and they didn't have time to go through full legal procedures for some things, and they ended up making some concessions with the bondholders of the bank holding company just to be able to get the deal done and get the funding that they needed to be able to bail out the bank. So it's easy to have incentives for people to monitor the bank. It's unlikely those incentives are going to be beneficial. If you have bondholders who have long-term debt in the bank, then after they buy it, they have no incentives to monitor. There's nothing they can do unless it's puttable, and so it's really kind of short-term debt and liquid. Then they monitor, but the monitoring isn't going to really help anything. It's going to help them to get their money out before the bank gets closed down, and that actually causes problems. Okay. Now there's another side to this. Is that there have been some papers, including some that were predated our work back then, that talked about how you need to have limits on deposit insurance in order to give people incentive to monitor. And last week we talked about last time I talked, we talked about deposit insurance as a possible way of preventing bank runs. If you have deposit insurance that's backed by the government, then the bank run equilibrium disappears. That was in an ideal bank that had no risky assets. The risky assets, people still won't have an incentive to run the bank, although the bank still could fail because the assets fail. But if you have people who have deposits that are not completely insured, only 95% insured. Let's say, okay, we're going to give everybody incentive to monitor the bank and make sure things are okay, so we're going to have 95% deposit insurance. Well, if you have 95% deposit insurance or 0% deposit insurance, and you get information that makes you suspect that the bank isn't sound, you get your money out right away. It's like having all of the cost of deposit insurance without any of the benefits. The other thing is, if you look at a lot of these depositors, except for the very huge depositor, you know, the people who are above the deposit insurance limit, somebody who worked for 40 years in New Jersey as a plumber, and his kids have moved out of the house, and he's retiring, so he just sold his house, and he's got all the money from his house in his account, and he loses half of it because of the limit on the deposit insurance. So a lot of that part of it is crazy too. That could be fixed by just doubling the limit or something, but the other problem is there whenever you have some deposits that are uninsured. So if you want to use deposit insurance to get rid of bank runs, you do that. The other thing is, of course, you don't want to do the Dr. Strangelove thing. Dr. Strangelove, they had a credible threat that they hadn't told anybody about. Right? I remember they had this thing where they would take bombs laced with iodine or something that would automatically, it's laced with something that would poison everybody. Tholium, I can't remember what it was. The so-called doomsday bomb that would automatically go off in the case that somebody hits you with an atomic bomb. And so you have this credible threat, nobody should hit you with an atomic bomb, because if they do, then you'll explode this. And it was in place, in the movie, the Russians had it in place, but they were going to save it to announce on their national day. Hadn't announced it yet. And so when this crazy Air Force general in the U.S. who was obsessing on purity of bodily fluids, purity of essence, yes, and on earth peace, which has the same
initial
three initial letters, went crazy and launched a preemptive strike on the Soviet Union. Of course, all the doomsday bombs exploded, and the problem is there's a credible threat that you didn't ever tell anybody about. So that's like the deposit insurance on the money market funds. There are no premiums, nobody knew about it in advance, so it didn't actually stop the run. But you put it in real time after the fact, and it sort of stopped part of the run. So anyhow, don't do the Dr. Strangelove thing either. Second thing, and this is basically Glass-Steagall in the old days, or the Volcker rule is a really watered down version of this in modern times, which is that if you raise money using retail deposits, it makes sense to have deposit insurance on those deposits. It helps prevent runs, and anyway, the retail customers are probably not that sophisticated in evaluating the banks anyway. That could be handled a different way, but in any case, you want to have that. So you want to have the banks doing things that are reasonably safe, and be able to monitor whether they're reasonably safe means the banks are not doing anything too exotic or risky. And so that includes very complex derivatives. That includes proprietary trading, investing in hedge funds, etc. So the nice thing about Glass-Steagall is it said, here's a short list of activities that commercial banks can participate in if they're protected by the Deposit Insurance Fund. This is completely analogous to what happens in the competitive market for corporate debt, that corporate debt has bond covenants. The bond covenants put limitations on what the company is allowed to do and give the bondholders some protection. For example, in some way or others, the covenants are going to make it so that the company cannot pay out a liquidating dividend to the shareholders and leave the bondholders without any assets backing their claims. They cannot make a major change in the line of business, etc. There are like 35 different common bond covenants, and these are just a couple examples. But a lot of what the bond covenants are there to do is to protect the bondholders from taking too much risk in the business. If you look at the deposit insurance fund, if there's deposit insurance, or just the retail customers, if there's no deposit insurance, then they're bearing the downside risk just like the bondholders in a corporation, and they need some kind of restriction on the risk. Banks tend to be heavily levered. There's debates now about how heavily levered they need to be, and we'll talk about that. But
how are banks? I suppose you've got a deposit taking, just a sort of mom and pop bank, a very simple bank.
A mom and pop bank.
Yeah.
I can talk about mom and pop banks too.
Yeah. Okay. But
Northern Rock.
like Northern Rock. Nice, nice simple one.
The mom and pop banks were the ones supposed to just your neighbors, and they have your best interests in heart, and that's why we need.
Screw you rotten. Yes.
Yeah, that's why we need to have the interstate and interstate banking restrictions and make it so that the big banks won't come in and sweep out all your money. But of course, the mom and pop banks had very low interest rates on deposits, very high interest rates on loans, and they were also the big lenders in the federal funds market. So they sent all their money to the big banks to lend to Argentina. So
that's the point I was sort of kind of gonna sort of make here. That you know, how does, I mean, so you've got a little bank that's supposed to just be like savings and doing sort of safe stuff, but how does the bank, you know, how does the bank know what's safe? I mean, how do you define what's safe? So you could,
well,
you know,
I'll get to that. The short answer is that in the old day we had bank examiners who go in and check the bank. And I like bank examiners, and I'll explain a little bit why we don't have bank examiners anymore. We can have bank examiners, but we do. There's no point in having Basel for a couple of reasons. And maybe there is no point in having Basel. But
Full stop, yes.
but let's talk about that. Okay, 100% reserve banking is risky because it stops liquidity creation. There are various proposals to move towards having bank assets backed entirely by short treasuries or by other things that are essentially riskless. In this view of the world, I have sympathy with one part of it, which is that it seems to be really hard to regulate banks, to make them safe. So it would be nice if we didn't have to. And so the idea is you have banks that only hold short treasuries, they have liquid safe assets, and you do minimal monitoring, which is just to check adherence to this rule and monitor for fraud. And that's a lot simpler than saying banks are making all sorts of risky loans, doing this and that and the other thing, and doing this. Presumably, that would separate the commercial banks. This would have the flavor again of Glass-Steagall. This would be the case for the commercial banks. If you have investment banks who are investing their own capital and not dealing with retail customers, they would have a lot more freedom. How much freedom is another question. But the thing that's the best, I say the best because it's my model, the best model we have for why banks are different and what's special about banks is it comes from the liquidity creation. And that's the Dybvig model we talked about last time. And I think it's an empirical question whether that liquidity creation by banks is surplus liquidity in the economy or not. If we have some initial evidence that it's not, that when the liquidity dried up in the shadow banking and the commercial banking, that seemed to do huge damage to the economy. And there are a lot of subtle arguments why it could be that that's misleading, and we'll talk about that a little later. But I think, for me, I think that probably it isn't surplus liquidity. If it's not, then you go to the 100% reserve banking, then the banks aren't creating liquidity, and that could be a big problem. So the liquidity creation, as in the Dybvig model, comes because the bank assets are illiquid and the bank liabilities are liquid. And that gives people, that's beneficial because it gives people who have shocks to their preferences opportunities for randomly arriving opportunities for new investments, beautiful car that they want to buy, whatever it is. It gives them the opportunity to have the flexibility to do that and have good risk sharing given that that's happening. Okay, another thing, the deposit insurance premium should reflect riskiness of the assets. I think that's a no-brainer. The hard question is how to implement that and what to do about that. It's not going to fix everything, but it's something that's useful to think about. Deposit insurance should be unlimited. That's related to point one. I've already sort of talked about that. You should have all the deposits fully insured if you want to stop runs. Number 6, and as we get to the bottom, these are things that I'm not sure Doug would agree with. I've talked to Doug about some of these things and he didn't react violently, but but that's different from saying that he's actually signed on to it. So this is, obviously in '86 we weren't talking about whether Basel has been doing its job. I think Basel structure cannot fulfill its objectives. The first thing about Basel is it's supposed to provide a level playing field. And that's, I think, the original reason for having Basel. Is that the countries that had strict bank regulation, banks said, it's great that our banking system is safe, but you're killing us because we can't compete with the banks in the other countries where the regulation is lax. And of course, the regulators said, well, we're not going to be in a race to the bottom where we compete to see how unsafe we can make our banking industry just to make it easier for you to compete internationally. And so the solution to that was supposed to have this international uniform set of bank regulations that would apply to all the banks in the world. And the big cost of that is that we've lost the bank examiners. The bank examiners, it's hard to have bank examiners that know all the different languages, local business conditions, legal environment in different countries, etc., and can go in and form an informed opinion on all sorts of different countries. And so Basel has punted on that and just said, we're not even going to try to do that, and they base the capital requirements on coarse accounting numbers that don't have very much information in them. And so when you're regulating based on coarse information, you have a couple of choices. One is that you can make capital requirements extremely high and extreme limit 100% capital requirements. Just say you have to, your deposits have to be backed by short treasuries, or you can, and in that case the banks are safe, but they probably can't do what you want them to do. Or at another extreme, you can make them very loose, and the banks can make lots of loans to small and medium businesses, which they seem not to be doing now, by the way, even this many years after the crisis hit. And but then the banking sector is extremely risky, and banks will fail. And if you have coarse information, you can't really get both sides. You can't really do both. So I think a lot of the talk we hear about, well, what should the capital requirement be, is kind of asking the wrong question. Because given the current structure, there's no sensible choice of capital requirement. And by the way, Basel has 3 pillars. We've talked about the market discipline, which I think is a joke. We have the capital requirements, which if they're very strict, then the banks can't do what they need to do for the economy. If they're very loose, we'll have lots of bank failures. In the crisis, by the way, we had both. We had bank failures, and we had that a huge shadow banking sector developed because banks weren't fulfilling the needs that people had. So you know, there's at least evidence on the face of it, prima facie evidence, that we had both problems on both sides. Again, there's subtle arguments that said, well, the only reason we had the shadow banking was because liquidity was artificially cheap and blah, 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 because of something the Fed did or something. I don't know. Anyway, I'm not sure. I don't think I believe those arguments. I'd say, when I look at it, it looks to me like we had problems on both sides. Now, the third pillar of Basel, so the first pillar is a market discipline, it's a joke. Second pillar is the capital requirement, which doesn't allow us to do what we need to do, given the rest of the structure of Basel. The third is that the individual countries are allowed to do the regulation themselves, like as before, on top of Basel. Before the crisis, Canada did this, and they put some requirements in the banks that left the banks screaming, but they're still there. Okay. The problem with the third pillar of Basel is that with the third pillar of Basel, if people use it, there's no point in having Basel, because we don't have the level playing field anymore.
So what you've called the third pillar, this is this supervisory review. So there's like I don't know if I number them the same way. The first one's the capital requirements.
I don't know what order they're in.
The third one is the disclosure and market discipline. And the one in the middle is the supervisory review pillar. So I was just wondering what distinguishes that from the old world that you talked about of the bank examiner.
That's the point. It doesn't, because you don't have a level playing field anymore if you have that. Okay, so you could say, okay, Basel's there, and in addition, you can do your own idiosyncratic thing in each country, but there goes a level playing field. If that pillar is important, there's no level playing field.
But it does at least stop the race to the bottom, doesn't it? I mean, if everybody's got to comply with Basel as a minimum level, then, you know, they can't sort of keep.
That's why
relaxing.
banks are just not regulated by in other countries from Basel, because they don't have the minimum prerequisites. For example, the Greek banks, they don't have the minimum regulatory capital
So they don't meet
that
Basel's
is required
requirements.
even to go on the pool that will be regulated by them. And the problem with that is that, for example, they don't have the CCB loans that they can take, other benefits that they could have. But okay, I mean, I see that as a safe pillow, not like as a disadvantage. I don't understand why you say that it's a disadvantage having different frameworks in different countries and total and
I'm
overall
saying
framework that if a bank wants, we go there and trying to be regulated by that.
Okay, so what I'm saying is that unless the capital requirements are set at a level that keeps banks from doing what we need them to do, the capital requirements are not going to make banks safe. Unless, I mean, if they're making them a little safe, then there's going to be a binding constraint on what banks could do and should be doing if you had good regulation in the third pillar. And if the third pillar is there, you've lost a level playing field. So the original reason for Basel. It's possible that net Basel does some good. I'm just saying, if you look at the objectives of Basel, level playing field, safe banks, banks can do what they want, it's not doing. It's a failure.
Well, those are contradictory in a sense.
Well, they don't have to be. They don't have to be. I mean, you have a trade-off between them. because I haven't said exactly what the level is of safety, but because Basel is based on these coarse accounting numbers and not on the finer information you could get from the bank examiners, then if they're contributing to the safety, then they're going to be constraining banks more than is optimal.
But I mean, I think one of the points about Basel, the original Basel anyway, was to try and impose some kind of sensible regulation across, you know, the level playing field idea, and it actually worked. I mean, lots of places implemented it, at least, perhaps not formally, but informally, and you know, sort of particularly in Asia, South America, and so on and so on. So this was a good thing.
No,
Unfortunately,
I'm not sure about that. I think that there are a lot of places that said, I thought I wish I could remember his name, or maybe it's better I don't. There's a guy I talked to at the European Central Bank who had been an investment banker. He'd done stuff with complicated mortgage derivatives and stuff, and he applied for a job with the bank regulators in his country. And he went in and he talked to them. He said, you know, I've made money in this industry, and I want to give something back to society. And it seems like a natural thing to use the expertise that I have about these complex derivatives and instruments and bring it back and help you in your regulatory role. And they responded, you know, you don't understand what we do here. You know, we have Basel. We don't have to look at all these details.
Oh, I see.
So I think that the fact that the Basel was there gave people a false sense of security, and some of these countries in Southern Europe that I hear people beating up, basically were going, look, we got Basel. This is, you know, now we don't have to look at it at all.
Yeah.
So I'm not sure that the net effect of that was useful in the regulatory environment. So that's a complicated question. Sort of the counterfactual saying, Basel, no Basel, are we in a better position? I think after what the economy has been doing the last 6 years, I think it's hard to say we're in a better position because of Basel.
And you could say that Basel II contributed to lots of the problems too.
Yeah, well, the different parts of Basel have different things, and it's a big set of things, and it's complicated, and I'm doing this broad brush, top level kind of, and inevitably and kind of naive in some ways analysis. But I think, you know, the nature of this is different from a theorem. I can't prove anything. You know.
Yeah.
You know. So that's theorem. You write down your assumptions, and then that follows to a proof. And here I can prove nothing. And the data are complicated and not as good as you'd like. And a lot of it's pointed at questions that are the wrong questions. It's hard to work. Anyway, my opinion is that Basel is not satisfying its objectives. Okay. And finally, asking about the appropriate capital requirement, this is the important point, which is the structure has a problem. If you're just saying at what level do we put the capital requirement, then we're asking where are we in this continuum between making the bank completely safe and the bank cannot do very much of what we want, to the other end, which is we don't care if the bank is risky, but the bank can make all the loans we want the bank to make. What we should be thinking about is what's the correct regulatory structure. We should be looking at bigger space, bigger choice space, not just at this one-dimensional thing. I was asked to chair a session at the Atlanta Fed conference a couple years ago, and the topic of the session was a good topic, which I didn't come up with, which was asking whether liquidity creation is bad, basically. The whole conference had a theme of the devil is in the details of how we implement all the rules that have been put in place. And so all the sessions had some kind of cute devil theme to it, which is strange, given that no land is in the Bible Belt. But anyway, the session said the maturity transformation isn't the devil's work. Maturity transformation could mean two things: interest rate mismatch, or a more interesting thing is liquidity creation. So you have illiquid liabilities, or liquid liabilities and illiquid assets. And they said, and the trend, I think, in the regulators is to demonize this and to say our banks are safe, and that they put in very stringent requirements on banks. And that was true then, I think is still true now. But I don't think that the regulators are looking as carefully as you'd like at the other side, whether banks are doing what we need them to do. Yeah.
I mean, I think on the last point, I think you want to write like regulatory capital requirement, not capital, because there is the regulatory capital requirement, which is, I think, what you was describing now, and the internal capital requirement, which every bank can develop the internal model, which is completely different to what you were referring to.
Yeah, I could say that.
Because
that's what I mean.
Regulatory capital requirement, the way you
internal capital isn't really a requirement; it's just a choice.
Well,
I mean, this is a dynamic
the
choice.
capital requirement based on the regulatory framework, let me say that like that, it's based on fixed formulas that, as you say, there may be mismatches of what they have to do.
So they're given a formula environment which may be somewhat vague, or it may be very specific.
Very specific.
I mean, in the current environment, it's very specific. Under the bank examiners, it was a little vague. It was like, we know that there are a lot of things that banks can do that would manipulate any kind of fixed formula, and so they actually I think intentionally stayed away from having fixed formulas. They had rules of thumb, and the banks knew about them. But they also knew that if they did something strange, it was just if the bank examiners came in and looked at it and say, this is just an end run around the formula, they would do something.
So I could see your point that the regulatory capital requirement is something that is not tailor-made to every bank, and this causes a lot of problems, and probably sometimes there is making worse than is a benefit. But Basel is also proposing the internal capital requirement. What that means is that every bank has the right to build their own model to propose how they calculate the capital requirement. And if Basel will approve this model, then they have the right to use it to calculate capital. This goes more to a tailor-made model, and also at the same time the regulator has approved that. So
when I was a student, I went to a seminar by Steve Smale. Steve Smale came to Yale and he gave two talks, one in the math department and one in Coles, which is within the economics department at Yale. And I actually was taking one math class at that time, so I knew some of the math PhD students. I was taking algebraic topology with Massey. And anyway, I went to his seminar. His seminar modeled nuclear war as a repeated game. Well, that was my reaction. That was my reaction. I said, so the idea was that in each period, if you do something bad, the next period you'll get punished. And he had these stage games that were all identical. And I said, after you press the button and you blow it up, there may be a game afterwards, but it's going to be completely different. It's not the same. And but this is what we have in the Basel model thing. It's like, if your model doesn't work, we're going to punish you next period. Well, you got 80% of your bank capital is gone, and the bank isn't there anymore, and you're going to punish them. It's the same model.
But it's worse than that, because if you think about the Eurozone, I mean, banks are essentially like airlines used to be. They're national champions. They don't actually regulate them at all. I mean, their aim is to keep them growing and be, dominate the Americans and the British and the Japanese and so on and so on and so on. And, you know, this is partly why Europe's still in a terrible mess in the financial system. And, you know, so it's not, I mean, I think what you're saying is very valid for the US, but for Europe, I mean, it's an even worse problem in my view.
Yeah, I think that's probably true. And there was a lot of pressure in the US, and I mean, that's part of where Basel came from, I think. There's a lot of pressure from the banks in the US who have a lot of,
The level playing field certainly came from Wall Street, yeah.
well, who have a lot of clout. They said, you know, you guys are killing us. And fortunately, the regulators had some backbone and didn't just cave immediately. Now, that recently they've caved, but that's a whole other story.
Well, I think they caved in 1998, actually, but never mind.
Yeah, they caved plenty of times. Okay. So anyhow, I've actually given most of the talk on the first slide. But that's the nature of this talk. Things are. But let me talk about some things. Let me see which parts of these I want to talk about. This is something. This is a classification that I think Doug would definitely agree with because it came from him. And this is a little bit old-fashioned version of banks, and when we start putting some modern things in it, like proprietary trading and so forth, it doesn't really show up in this picture. But those are sort of not commercial banking things. So this is like a commercial bank story, and we have asset side services like originating and servicing loans, and liability side services, accepting deposits and providing cash and debit cards and things like that. Then we have transformation services, just creation of liquidity, and that's what I talked about last time. We talked about that in our paper. And so I think it's a really important empirical question that I have an opinion on, but I don't know that it's been really proven that the liquidity creation by banks is important. If it's not, then we're wasting a lot of effort trying to regulate banks with a lot of risky stuff and trying to make it not too dangerous, when we should just have narrow banks that just hold liquid, safe assets.
I mean, that's your opinion, and I strongly agree with it, but isn't it general opinion that that's one of the main things of commercial banks?
Well, you know, I would think so, but it's still an empirical question.
Well, it is.
And if you look at, let me make an argument on the others. Okay, first of all, there are people who are pushing hard for extremely high capital requirements, which kills liquidity creation, and also there are people who are pushing for 100% reserve banking. So these people don't buy it.
No.
Okay, and so okay. Here are a couple of arguments if I want to make arguments on the other side. One argument says, look, we used to think that we could regulate banks and keep them safe, but a whole string of problems we've had suggest maybe it's a lot harder than we thought. Like when I was growing up, bank regulation worked for a lot of years, and we thought that it worked pretty well. But we had the S&L crisis, and we have this crisis and that crisis, and pretty soon we have these frequent crises, which we're saying, oh, that's just an idiosyncratic, anomalous thing. Well, it's not an idiosyncratic, anomalous thing. There are a lot of these things, and they're a problem. And maybe these nebulous benefits of liquidity creation aren't really good enough to balance the problems we've had. Another argument is look at the size of shadow banking compared to the banking sector. It's much bigger. Yeah. So maybe the banking sector isn't that big in terms of the economy to be producing the kind of benefits that we want to have.
That's a slightly different argument.
So, I don't know, I don't
the
like
point is
these
that
arguments.
there has to be
I
something
don't
in the
buy them,
economy.
but I still think it's somewhat of an open issue. And I would like to see more work done on figuring out whether that liquidity is really that important, because it really matters for the regulation. If we just go to 100% reserve banks now and shut down that liquidity creation, that seems like a risky thing to do. That it might be very important and it might cause a lot of damage. And I'm guessing it probably would. I at least my distribution has a lot of points and a lot of parts, a lot of the body of the distribution is in place where that'll do a lot of damage. But it's an interesting. I still think it's not really proven.
Well, I think there are sort of three questions there. I mean, I see it absolutely, there needs to be something like old-fashioned commercial banking creating liquidity, it seems to me. Part of the problem with liquidity creation, as it's argued since the rise of derivatives and all kinds of structuring and all this stuff over the last, 30 years, is that what's called liquidity is actually not really liquidity in the sense we're talking about. And so we have to be careful of what we mean. But I think your argument that I thought you gave earlier is that the reason the shadow banking system has risen in part is because the banks were in fact failing to give liquidity in the old-fashioned sense. But from the point of view of macroeconomics and advance and creation and everything else, I mean, you need liquidity, don't you, in the old-fashioned sense, seems to me. Where it comes from. I mean, then your third argument, I mean, what you just said is that maybe for a long time that kind of liquidity hasn't been coming from the banking system, it's been coming from other systems. And
Well, if it comes from the shadow banks are also subject to risk. Let me.
Yeah.
Okay, so here's a traditional bank regulation. We had in the U.S. we had bank examiners who actually go in. They're like old-fashioned accountants. Accountants today, their job is to, if you audit a firm, their job is to ascertain compliance with GAAP. That's something that's more, makes it easier for them to avoid litigation than the old job of the accountants, which was to say that the accounting statements accurately represent the economic status of the firm. But the bank examiners were like those old accountants. They were supposed to look at the substance and form an opinion on the safety and soundness of the bank. And they could look at a lot of details. They had a lot of information. Glass-Steagall separated investment banking from commercial and mortgage banking. You hear, I mean, Glass-Steagall has some bad press, and certainly one of the political factors in it getting adopted was that Huey Long, who's a great populist politician from Louisiana, hated J.P. Morgan's guts and relished the idea of splitting his empire in half. But it also had this other side to it, which was more substantive and actually made economic sense, which is that if you're going to have this insurance backup to deposits, then it shouldn't be possible for the bank to throw just any kind of risky activity under that umbrella. And so the idea was that you've got the investment banks, which are kind of the Wild West, and they are using their own capital and they can do lots of things that they want to do. If one of them fails, it's like any big corporation failing. The other investment banks will make more money and will find it easier to attract talent and face less competition, and then they'll grow and replace them over time. But it won't directly impact the deposit insurance fund or the banking or the commercial banks. And then the commercial banks are just allowed to do a short list of things. How short is a question. It would have to be adapted for modern, the modern practices. Like what things are they allowed to do in terms of mortgages and repracticing mortgages? Probably the original Glass-Steagall was written at a time when it wasn't anticipated that you'd have these complex multi-tiered derivatives. Okay, we've talked about this a lot. Let's see. Shadow banking, huge unregulated repo market. Okay, so I feel very confident that we should be regulating commercial banking where we're providing the deposit insurance. That only protects the deposit insurance fund. How much we should be regulating the shadow banking, I'm much less sure about. On the one hand, there's a market there with the structure of which is subject to runs. It's not very much different to say, I have a deposit in the bank and each day I have an option to take it out. It's formally the same thing to say, I invest in a repo today and each day I have an option to roll it over. The default is different, but it's the same choice. Do you roll it over or not? And so, just like banks, the repo market is subject to runs. If you can't roll over your repo, then you have in effect a run. Repo, because the repo, rather than a straight loan, it has some collateral, but for this to create liquidity, which it did, you need that the collateral value is a lot less than the value of the loan, and for that reason, it's subject to a run, just like a bank. And there's a nice paper I like because it's almost like an ad for me. But there's a special issue of the Federal Bank of Richmond Economic Quarterly on the Dybvig model. And I don't know, some of you may know Ed Prescott, he's a famous economist, a lawyer. This is his son, Edward Simpson Prescott, and he goes as Ned. But he's an economist at the Richmond Fed and wrote this nice article that talked about all the different things in the financial crisis that looked like Dybvig bank runs. Including the commercial paper market, the repo market, the money market mutual funds. So these.
I'm just sort of thinking. I mean, isn't there a bit of a difference with the? I mean, if you want to sort of put your money into some sort of repo agreement, you have to have someone on the other side who's willing to do that. Whereas if you want to go along to the bank and just hand in, $10,000, then they've got to take it, haven't they?
Well, this is why I don't know if the bank has to take your deposit, certainly not in England. I mean, I don't think, you have to know somebody to open a bank account.
Once you've got the bank account, right?
Once you've got the bank account, yeah.
Yeah, that's the problem.
You can go and put as much money in it as you want, but
You've been there.
So as soon as they come here, they're not from European Union, they go to the bank, they try to open a bank account, they don't have, they cannot do that.
oh, it's just a nightmare.
It's really
It's
just
a
a
nightmare. Just a nightmare.
Yeah, I used to have a bank account here. Michael
Once you've got a bank
actually
account in the UK,
signed for
just
me.
leave £50 in it for every.
But anyway, back to this. So the question is it's subject to runs, and therefore there's some potential benefit from regulation of eliminating the run equilibrium and keeping the good equilibrium. The other side of this is to say, look, they're doing it on their own account. If they want to get in this market and it's subject to runs, it's their money. And I don't have a strong opinion on that. I do have a strong opinion about the commercial banks, and that deposit insurance is useful, and I have libertarian tendencies, but there's certain things like the rule of law and these things which I like, but I think in the crisis you couldn't let the failures in that market was a problem, mostly because if you let AIG fail, then a lot of commercial banks are going to fail, and that's the big problem, and it's hard to deal with that. And so they
Mind you, you didn't have to bail out Wall Street 100% either.
you're preaching to the choir here. I mean, On the other hand, also, I wasn't in their shoes and facing the decision.
True.
So that makes it a lot easier to sit back and criticize. This is a quote from our paper in '86, which I like because it's a pretty good short description of what happened in the financial crisis. And this was in '86. So when people say, well, I predicted the financial crisis, well, anybody can say that. But this is sort of saying that thing. This is saying,
In a deeper sense.
yeah, this is saying that if you have banks that are regulated too tightly, and banks were regulated too tightly and too loosely because they had this really coarse information. So it wasn't tightly enough to, they weren't regulated tightly enough to make them safe. It wasn't loose enough to prevent the formation of this huge shadow banking market, and may inherit the problem of runs. Okay, well, this is what happened. And that's a lot of what happened. I mean, this repo market was much bigger than the real estate market in the US. Real estate market in the US may have been a trigger, but it was tiny. All the losses, total losses on mortgages is tiny compared to the collapse of this repo market. There's a broad monetary aggregate, I think it was M3, that includes these repos that the Fed used to collect. And this is like perfect timing. 6 months before the financial crisis hit, they stopped producing the statistic because they thought nobody was interested. The broad definition of money that includes the money creation that's implicit in this market.
So would you see the shadow banking expanded because the banks were being more tightly regulated?
Well, that's a good question. Let's see.
Hard to prove that one.
Well, what about timing? I mean,
Well,
when-
so what's, I don't know. So, I mean, this is a little softer than what I just said in the thing. So you had this huge unregulated repo market, and there was liquidity creation. Some of the assets actually that people use as collateral could be rehypothecated, which meant that when I give you collateral, you don't have to hold the collateral. You can actually use it yourself to borrow some more money, and so you get a multiplier effect.
Yeah.
So these are possible causes. One is sort of regulatory arbitrage. Okay, there's no reserve requirement on this. There would be if you put deposits in banks, and you have to pay some kind of shadow price for that. The limits on deposit insurance, people look at banks and say it's unsafe to take that big a position in putting money in a bank account. There's a cool paper on liquid pools. The author's name is Zoltan Posner. Very cool name. Sounds like a magician. But it's a big paper on liquid pools, and there are apparently these big liquid pools of money that come from different sources. And one of these pools, the average size of these big liquid pools of money, if they divided the pool equally among all the banks in the US, including all the little tiny banks, that it still would exceed the deposit insurance limit. They're huge. And people have to have a place to park this. They did some of this in money market funds, they did some of it in repos in different places. So there are different places these come from. It could be that maybe you have an endowment that you're managing and it has a synthetic equity part, so you need to put a bunch of stuff in cash. I don't know. There are all sorts of different places that these pools come from. Some are insurance companies. I've started to write down a liquidity management model for an insurance company. I went and talked to people at an insurance company, and they say I can't remember, the numbers were huge, but it's like on 48 hours notice we can produce $500 billion worth of liquidity because being able to do that, the reason we put that in place is that being able to do that is very reassuring to the regulators. And so I'm going, well, there's no trade-off here. This is not going to help. You know, it's one of these things where you have this nice idea, which is that you know, if you have a random demand for liquidity, that you hold a combination of longer things that are liquid that you get a premium for, and shorter things that are illiquid, that trade off the benefit if you don't have to pull it out and the cost if you do, and it turns out that that's irrelevant for insurance companies because of the regulation. Another beautiful theory shot down by an ugly fact. That's the way things work. Anyway, here's some possible things. So anything I think you know, there's some evidence that Basel would be part of the problem. We're not sure. Okay, how to eliminate bank failures completely? Just make it illegal. So the people in the government, and nobody's actually proposing this, but I'm saying this is kind of the logical extension of these arguments.
Well, wasn't the Soviet Union virtually a totally cash economy?
Yeah, maybe, I don't know.
It was. Yeah, there was almost nothing in the way of banking in the Soviet Union.
Well, not in the sense of liquidity creation, no, but look what happened to the Soviet Union, though.
Yeah, well.
Yeah, so I think this has gone backwards. There was a time a couple of years ago, I guess it was at this Atlanta Fed conference. I was sitting with Ben Bernanke at dinner, was when he was still chairman of the Fed. And at that point, they had actually had unlimited deposit insurance on demand deposits that paid no interest. So it seemed like they were moving in this direction, but I think that I'm not sure that that's still in place. That was more, I think unfortunately, they thought of that as more of an emergency measure. So anyhow, I think my time is up. I don't know, do you have any questions? There's a lot of stuff here. It's kind of, I know it's kind of like discuss, you know, it's like a mushroom. You can push on it. There's nothing. What's there? Yeah.
What does narrow banking mean?
Narrow banking is like 100% reserve bank. So all you do, if you look at the 86 paper, it's a little embarrassing, but it described that as what money market funds do. So in good time, money market funds hold things that look very safe. So they have safe liquid assets, safe liquid liabilities. And if you get half the people take their money out, no problem. The stuff is really liquid. You just sell it, and it's not a problem. So that's what a narrow bank is. 100% reserve bank or narrow bank are the same thing. Of course, the money market funds engage in what Doug refers to as a popular game on Wall Street of getting 1% above treasuries practically risk-free. And so what they would do is they would buy things that are very liquid and almost riskless in normal times. And they were the big buyers in the bank commercial paper market. And so they buy the bank commercial paper, and because in some contingencies it could have problems, it had a premium on it, and then you could advertise to potential customers that you have a higher yield than the other money market fund and attract some customers that way. And so in normal times, it's just purely matched liquidity, illiquid stuff. But in the crisis, when